I recently took the ERP exam. I found preparing for it difficult. At first, you're studying to learn something, but there comes a point in time where you really have to prepare for the test. Anybody who started to read through books they give you, there's quite a bit of volume, and you just don't really know what's on the test. There's few practice exams available, so I wanted to give a review of what I found in the exam versus maybe what was on the practice tests. Hopefully this will be an aid to people who are also studying, and perhaps if I fail, it'll be a good review. Now, remember there's 70 questions. The first half's on physical electricity markets. The second half, another 70 questions on financially traded products, risk management, credit. You have 4 hours for each section and a 2-hour break for lunch. There was plenty of time to actually do the questions if you had an idea what the answer was. Of course, don't be late. They will lock the doors. So I'm breaking this up into 2 sections, physical electricity and then the financial. So these are some of the questions that I saw on the practice test that I again saw something very similar on the actual exam. On power generation, merit order of dispatch, so the cheapest bids get picked up first, and all the generation gets paid the clearing price regardless of what they actually bid in. So it's the top bid, if there's 300 megawatts that's needed, guy bids 100 megawatts at $50, the next guy bids 200 megawatts at $80, everybody gets paid $80. Something else, freight on board, cargo insurance freight, delivered ex ship, those shipping classifications. There's a question on placing the NGLs in order from lightest to heaviest. There's a question on placing generation in order by lowest marginal cost to highest. Royalty and production sharing agreement calculations, that was on there. A question on what is profit oil, who has liability for E&P costs in PSA, same thing for royalty, the IOC has it. You have to know API gravity and sulfur of either WTI or Brent. A recovery rate of well using enhanced recovery, 70%. What a pipeline would do for short-term storage, line packing. What conditions observed in the market would cause a crude trader to execute a cash and carry strategy? It's a question I'm not 100% sure. One answer I thought, which I put, was full carry contango. The other answer was convenience yield. A lot of these questions you can get down to 2 possible answers pretty well. And then sometimes there's a uncertainty. Another example, what type of rock shale gas is in. A lot more confident with this, reservoir rock with low permeability. Another one that's like, well, maybe the anticlinal trap with low porosity. Unless you deal with stuff on a day-to-day basis, you might read something 2 months ago and now you're trying to retain it. So some of that can be a little difficult. Myself, I work in the power business, so those calculations are secondhand to me. Gas E&P stuff, it's a lot newer material. There was one on an FTR calculation. Not only do you have to know sink and source, you have to know whether it's day ahead or real-time prices, and it's actually day ahead. Know what a capacity factor is, and know what spark spreads are, how to do those calculations. So those are type of things I'd seen on practice tests. I tried to go back, not only the 2015 test, but try and download stuff I could find going back as early as I could. A lot of those practice questions overlap, so it only gives you a limited exposure of what could be on the test. There's other questions that are on the reading but not on the practice test. So one of them was, what's the purpose of hydro treating? And hydro treating being something in a refinery to remove impurities, but there's also a lot of other options, or cat cracker, or stuff that they could ask about. So luckily I was able to remember that. Another similar question, what would be the driver for adding a coker? Sometimes they put these questions in different formats. There was questions where you had to kind of understand some contract language, know the difference, like net back and deadband. There was a question asking to calculate the contract for differences for Brent. In the beginning of the fourth book, there was all those ratios. So one of them they tested on, the finding and development reserve replacement. Ancillary services in the electricity market, so spinning, non-spinning, regulation. So again, regulation is controlling voltage, spinning is essentially unloaded capacity to account for if a generator trips offline, and then non-spin is a unit that's offline but that can start really quickly. There's a question on wind development, so ideal wind speeds, and then it had with gusts or without. Pretty sure gusts are bad. There's a question on what is contract of affreightment, so regards to shipping. And the question could have easily been about spot or charter. There's a question on transportation costs of crude oil from the Middle East to Japan. This is where a calculation where you have to do the world scale 100 times the time and tonnage. They also added interest in here, and this is one of those things that they do which is frustrating. So they said the contract included interest, but I don't remember seeing interest in any of the calculations. So you're sitting there like, well, does it include interest or not? And answers come out to be both, one or the other. So this is how sometimes the test can throw you for a curve even though you think you understand the actual answer. There's a subsequent question about hedging crude prices in Japan during that shipment. So you would sell Brent and then buy the JCC basis. There was a question on calculating a hurdle rate for a project. So they gave you the equity cost and share, the debt cost and share, tax rate, risk premium. So basically remember the 1 minus the tax rate is your debt cost. There was something on impact of renewables on stability, on the power grid. There was another where you had to calculate whether to buy from the market or self-generate, and the trick was they added in start costs. There was a question where you had power sold in the day-ahead market, you had a partial outage of your plant, and you had to buy in the real time to make up, so you were calculating how much you owed. And another question on hours of lost load, so they gave the load and how much generation you had, and then they had these partial outages. So only when your outages, less generation was less than your demand, that's when you have a lost hour. On the financial risk and credit, there was calculating a cross-hedge ratio. There was a question on how many contracts to buy in a cross-hedge. And then there was something on calculating the delta and gamma of a position. So you got to make the position delta and gamma neutral. So it's usually, this one was selling stocks to make the portfolio delta neutral. There was at least 3 questions which touched on expected loss. So 1 minus the recovery rate times probability of default. There was multiple questions on your VAR calculations, so your exposure times your Z number times your volatility. There's a question on stack hedging. There was a question on when to stack hedge, so if you have less liquidity going out in the future. Calculation where you had to do this synthetic commodity. You had to calculate next day exponentially weighted moving average. There was some simple questions on crack spreads. It wasn't as detailed as any of the examples in the book. There was a question on swing swaps. There's a question on credit value adjustment. I don't exactly remember what those questions were. All this is from memory. I kind of jotted down some notes afterwards in order to remember some things in case I need to take this again. There was one where some of the practice tests you had questions on Brownian motion and some of the other modeling types. I actually spent a lot of time trying to understand those. It was helpful, just not the detail that I was looking at. So here, an analyst was looking at electricity prices using this formula where they gave you. They said, all right, here it's got to jump to the fusion portion. It's got the Brownian motion portion. What doesn't include? And I'm pretty sure the answer was seasonal adjustments. So you have to understand the model a little. There's a question on skew and kurtosis. So it gave you a distribution, a mean, and some data points, and saying, oh, what's noticeable about the distribution? And then there was a calculation on weather derivatives. So you have to calculate your cooling degree days. So those are questions I had seen on a practice test. There's a lot of things that weren't on the practice test. His second half was a lot harder than the first half, at least for me. So there's stuff on credit support annexes. So what does a valuation agent do? You have to understand the collateral threshold, minimum transfer. This is probably the worst question there. They gave you the default table. So this is the table where you have a triple B bond and it gives you the percent chance of defaulting, but then also the percent chance of going better or worse, A to B to C, whatever. And the way the question was phrased, it was extremely confusing. It was just saying the rating of the bond dropped, but it didn't say where it started from and where it ended up, and was asking you what the default probability was. So it's a little frustrating when you understand what the concept is and you just don't even understand the question. There was a question on when compared to pre-settlement risk. Settlement risk is, and then it was either frequent, less frequent, larger impact, or less impact. There was some questions on the characteristics of gamma with respect to options. So in the money versus out of the money, it's time to expire approaches. These weren't multiple questions. It was types of answers they give you in what is true about gamma with respect to options, and there's several things that are plausible. One thing that's always tough to remember is what volatility does as time to expire approaches. If I would recommend, I would just go to a calculator online that spits out all the Greeks and just play around with in the money, out of the money, and see how some of this stuff changes. That could be helpful. There was a question on calculating the payoff of an Asian option, so that's where you had to average all the prices that are paid or observed throughout the period and then decide if there was a payoff. There wasn't. There was a question where this analyst was looking at electricity prices over a 5-year period. What's the best distribution to use? And Poisson chi-squared, log normal, Bernoulli. Pretty sure it was Poisson because that has a time series element in it. You had a question on the variance of a weighted portfolio. Here they kind of threw a little trick in. They included VARs of a gas portfolio and then an electricity portfolio, or part of the portfolio, and then they gave percent weights to it. And I think the percent weights are only a factor if you just have the volatilities of those. But if you already have the VAR, I actually don't think it plays a factor. Of course, when you're sitting in the exam, sometimes you don't know which equation or whether you need to add it. Part of the problem with the exam is the breadth of information that they could test you on. And it does throw you for a loop sometime when something you thought you read and you're going back to your head and you're like, wait, is that included or not? There was a question on back testing, the probability of VAR. There was something on a risk analyst notices an inverted J curve in a country. What does that mean? One of those questions where I remembered seeing a J curve, forgot what the axes were. There was one on operational risk management, the butterfly, where you have a bunch of potential causes. It goes down to the event, and then there's a bunch of potential outcomes. There's a question on basis. It said how there's loss and unaccounted between Henry Hub and Algonquin was 8 cents, and then they said on 2 days the realized cost or cash cost at Algonquin, it was like 262, and Henry Hub it was 280. Said, what's the realized basis? So one was negative 18 cents, the other being negative 26 cents. And there's a couple other answers which were not even close. So do you also add in the loss unaccounted, or is it already embedded in the basis? The way we see prices in the power industry, it's already embedded. So I said it was negative 18 cents. I don't know if they're trying to be cute with words with this realized basis, or just not necessarily confident. There were several questions about liquidity and risk, but it wasn't the ask minus bid over mid calculation that I had looked at and prepared for. There was questions on netting, question on central clearing. A lot of these questions are like, what's the benefit, or understanding the purpose, or what risk is mitigated. I can't remember the exact questions. There's something on exchange of futures for physicals. What's the benefit of it? There were several questions that were from left field, so I probably should have said this earlier. What I'm trying to structure this presentation about is the big picture, what's the most common, and then drilling down. I think it's tough to prepare for every possible question. So one was, what's the reason for why the crude oil storage report may not be accurate? There was answers that range from, people don't have to report, to technical issues about location. There was a question on why the Oman Dubai pricing hub was established. Thought it had to do with quality of crude, but I'm not sure. There's another one where it was, a well was discovered to have 65% CO2, and what does that mean? There's an answer where it was uneconomic. There's another answer where it increases the pressure and helps withdrawal. I know they do CO2 injections, so I thought that could be a potential answer. There's another chart, another question that I knew, but I thought for a lot of people they wouldn't. They gave this chart with TEDCO M3 versus NYMEX prices. These are gas prices, and then it's why is the summer basis depressed? So for anybody not really familiar with the gas business, TEDCO M3 is a pricing point up in the New Jersey, Pennsylvania area, next to some of the shale plays. So one of the answer was sustained shale production from the Marcellus and Utica shale. So I thought it was a little weird, because if you didn't know where TEDCO M3 was, there was another answer with the Permian Basin being the answer. You might have went with that. There's another very confusing question on how to mitigate reserve risk when operating under a volumetric production payment. I had no clue. There is also a difference. Another surprise is what wasn't on the test. So there were several things which I studied for, prepared for, it just wasn't on. Most notably, binomial options. I had those calculations down pretty well, not a single question on it. There was nothing on the architecture of electricity markets, where they go into power pool versus wheeling, decentralized. There wasn't anything on that. There wasn't anything on gas to liquids or coal to liquids. Those had been on practice tests. There's nothing on coal quality. There's nothing on the gas nomination. Very popular in practice test, there's nothing on storage theory where you had risk and convenience, yield, and you had to add all that. There was nothing on the coupon rate of a risky bond. Along similar lines, there's nothing on the approximation conditional default probability. There's nothing on proven reserves, BOE equivalents, associated gas, nothing on barrier options. So that's one thing that came up a few times in the practice exams where I had to go really look them up and learn about them. Nothing on them, which is disappointing on some of these things. Now for the online readings, those are the things at least I pushed off. There are several things that you typically got one question on each reading, and they're generally it's the what's the main purpose. Sometimes it was an obscure question, so real option section was really simple. It was, hey, you have a option to spend money for tertiary recovery on a well, what's the strike price? Well, one of the answers was like, oh, it's the cost of the tertiary recovery. No, it's the price of gas. On transporting crude oil by rail in Canada. This is kind of one of the offshoot questions where it was actually asking what is bitumen diluted with when it flows in order to make it flow in a pipeline. And it's got really nothing to do with the main topic about rail. There was a question on, if LNG is linked to oil via S-curve, what does it do? So again, this wasn't the most prominent thing about wholesale gas price formation. There was nothing on unconventional oil. There was a question on the natural gas trading hub. I think what it does or what risk it avoids. A lot of these on-ride readings are going to change year to year, so a lot of these may not be applicable. There was nothing on wholesale electricity market design. There was nothing on global coal supply. There was a question on basically, what is direct load control? So this is kind of a subset question. There was a question on German renewables. What was the impact of renewables on wholesale prices? And with regards to project finance, there's a question on who gets paid first before lenders, so operations and maintenance. On financially traded energy products, there's questions on all of them. And I've written them out here. Compared to a traditional trading firm, how would the balance sheet of a vertically integrated commodity firm look? That wasn't something I took away from these readings. Usually I would skim them for the main point, the topic, so sometimes these side questions definitely threw me for a loop. I figured vertically integrated, you're in the refinery space, you're in the E&P space, went with more long-term assets and liabilities, and I think that's actually correct. One on derivatives market. So this reading had a lot of overlap with stuff that was actually in the book. But this question was on, if you think volatility would dramatically increase, how would you structure an option strategy? So this would, So you'd buy a call, buy a put at the same strike price. There were two short readings on Dodd-Frank, and the question had to do with end user exemption, but then the answers, one included foreign exchange, one didn't, in what was exempt. I still don't know the answer. Risk management, this COSO, there was a question on this risk appetite. Basically just have to understand what it was. The implications of E3, so something where a failure was caused by an operator, and what would be an E3 response, so this would be a purely technical fix. And then there's a question on GARP code of conduct, which is kind of common sense. So this is stuff I remember. I know there's not a lot of material out there. There is that guy, he's got these Vera risk concept packet that he sells for $60. I actually did buy it. It's good, but not great. It's still too dense. I mean, it's over 1,000 pages of PDF, or pretty close to 1,000 pages. So it still takes a lot to go through all of his questions and answers, and sometimes there's tables with lots of information. It doesn't really say, hey, this is the stuff you're definitely going to be tested on, or 90% chance you'll be tested on. It's kind of like reserved. What's your P90, your P50, your P10? Kind of a study guide would be valuable in that sort of format, in order to to understand what are the high points, and then let's drill down a level, and then maybe even not touch on the P10 stuff. I mean, there's stuff you're going to get wrong, and you prepare for one question on, say, the back up to the volumetric production payment. You can learn that, and it's something else that's completely off the wall. So if I had time and energy, it would be something that would be interesting to produce, maybe with other people, but right now there's nothing out there. So, well, thanks for watching. I hope any of this was helpful. If you have any questions that